Hi folks, Chuck Gibson from Financial Perspectives with the first quarter of 2019's hot mess version of Charts on the Move video. This is my first video since changing to the quarterly format. In spite of extending the time frame, not much has changed from a longer term perspective. Shortening our time frames though, stocks have done exactly what you'd expect them to do when you get massively oversold like they did in late December. They rally hard. The reason I'm calling this the hot mess version is because, well, when you look at the longer term, we are not yet making new highs, but instead in an area of consolidation, which are not ideal from an investment standpoint. We know stocks only do two things. They trend or they consolidate. Trending can be up or down, but in either case, it makes investment decisions easy. When stocks are uptrending, go long and risk as much as you're willing. In downtrends, the best outcomes will be from either being in cash or shorting stocks. Consolidations, on the other hand, by definition are unclear and will either end with the resumption of the trend or reverse their direction. In other words, a hot mess. Let's take a look at a few charts and see what I mean. My first chart is that of the US S&P 500 index. In the upper pane, you can see RSI momentum divergence warned of the upcoming pullback. In the second pane, you can see the ratio of S&P 500 to the world stock index minus US stocks. The 8-year outperformance of the S&P 500 continues. In the middle large pane, the S&P 500 price movement, you can see we made a lower low in December and are still below last August high, but only about 5% away. Price is also above a flat 200-day moving average. I can't go without mentioning here again, my experience has taught me that being invested while the 200-day moving average is flat is almost always frustrating and usually dead money. Typically, this only occurs when prices are consolidating. But the most money is made when prices are making higher highs and higher lows, and a rising 200-day moving average. Something that is not occurring with the S&P 500 just yet. Looking left, you can see where the other two consolidations occurred in this uptrend, both taking more than a year to find their catalyst to continue the move higher. My next chart is that of the European index, VGK. Notice the similarities and differences between this and the prior S&P 500 chart. In the second pane of the ratio, the downsloping line illustrates how badly European stocks are underperforming world stocks minus US stocks. European stocks, like most risk assets, caught an oversold reversion to the mean bid on Christmas Eve. But instead of being just 5% away from the prior false breakout high like the S&P 500 was, they currently sit more than 18% below. The 200-day moving average is pointing decidedly down and a long way from turning higher. Price is trendless as it sits in the middle of the most recent high and most recent low. I need to point out the early 2018 false breakout is a great example of the investing adage that from false breaks come big moves, also known as a bull trap. This was a big move, more than 26%. Like the US, Europe stocks are consolidating, currently in between the most recent past high and low. Before leaving Europe, let's take a quick look at Germany, since it is, without question, its largest and most important economic force. Unsurprisingly, it looks almost the same. What jumps out at me, though, is that it's even weaker than Europe as a whole. Notice how little their market has rallied since December's low. This, right here, looks like a bear flag and wants to go lower, much lower. If Europe's economic powerhouse is this weak, it does not bode well for Europe in the short term. I've been saying for years, Europe is in deep trouble going forward, and their stock markets are really reflecting this point. Interestingly, when moving over to the emerging markets, you can see the striking similarity between them and Europe. It is no surprise, as their largest trading partner is Europe. So, as Europe goes, so goes the emerging markets. Be careful of who you sleep with. Their stocks too have been underperforming the world index ex-US, as you can see in the ratio line in the second pane. What is very different is the ratio has been basing sideways for years and is making slightly higher highs and higher lows. If, and I say this again, if this continues, this is positive and constructive, and the main reason we took a small position in clients' accounts. Prices rallied from December low, but is still more than 21% from prior highs. And, like every other stock market we have looked at so far, it is muddling between the most recent prior high and low. In addition, the 200-day moving average is still declining, but it's starting to flatten, neither being ideal nor compelling reason to be excessively long. Hopping over to Asia, nothing really different here. just more of the same. Their stocks too are underperforming against the world stock index minus US stocks. Like the emerging markets, the ratio is starting to base, forming a nice rounded bottom. This is constructive as higher highs and higher lows point to the potential future trend reversal. This is definitely something worth keeping an eye on. Prices above a declining 200-day moving average and still in the middle of the most recently made high and low. My next chart is that of the unloved stepchild, commodities. I have not seen a sector that is down as hard and continues to stay down as commodity prices have. The talking heads have been warning of inflation and a rise in commodity prices for years, but so far nothing. As you'd expect, they too are underperforming the global stock index ex-US, but massively so. What is interesting is the 4-year sideways consolidation they have been in. The adage of the bigger the base, the higher in space is screaming out here. If and when this breaks out, it could be one of the greatest investment opportunities in the last decade or two. Strong bull markets are sparked by big bases. In case everyone has forgotten what an uptrend looks like, my next chart is a perfect example. Ha! It's the US Aggregate Bond Index. Ever since the experts called for the demise of bonds, bonds have once again proven the majority wrong. You can see their prices broken out from a 3-year consolidation and is now making new highs. The 200-day moving average is pointing higher, with price well above it. This, dear viewers, is an uptrend. Before moving on to wrap this up, I want to point out in the bottom pane the massive increase in institutional accumulation confirming the breakout. This, from a technical standpoint, is an ideal setup with a confirmed breakout. The only ones who can create those large volume bars are institutions. For the healthier portfolio, you'll always want to follow the big money, and the big money has been piling into bonds. Before closing, I want to go back to stocks. There are always going to be exceptions within the components that make up the index charts I present, regardless of whether those indexes are going up, down, or sideways. As of right now, my scans show there are a number of individual stocks, sectors, and commodities that are in clear uptrends, in spite of the underlying index they're in being in consolidation. But for the index to eventually go higher, it will take more than just a few exceptions. In fact, you will need the majority of that which make up the index to move it higher. Here's a chart with a listing of all US stock sectors and their change since January and September of last year. It's not important the amount that they're up or down. What is key is whether they are up or down, green or red. As you can see, most sectors, 67% of them, are lower than where they were 14 months ago, while 71% are lower than where they were 6 months ago. The point is the underlying components of the world's strongest stock market are not healthy. The internals are weak, and as such, it's clearly too early to know whether this consolidation resolves higher or if we have entered a cyclical bear market within a secular bull. Either way, I would expect we not find out this for months. So for now, we sit on our hands and wait for new highs to be made. Good things take time. Well, that's it. Thanks for listening, and as always, I appreciate your time and your attention and hope you found this video informative and helpful. If you have any special requests for the next installment or comments, I'd love to hear from you. You can send me an email at chuck@financialperspectives.biz. Again, thanks for listening, and until next quarter, this has been Chuck Gibson from Financial Perspectives with Q1 2019's Charts on the Move.